Today is the 27th of April 2009 and this is the Forexserve weekly update. Last week we saw the markets responding favorably to the good news from the US banks and from the Euroland. But of course we saw again at the end of the week the fears related to swine fever creeping up, and this morning we have seen because of that fair sell-off across the board, because people are still worried about what happened during the Asian flu crisis. So I think this week going ahead we'll see this extraneous factor assuming a larger proportion in creating risk in the minds of people. And of course the global stocks will be viewed for the valuation purposes, which has been the basis of the market's turnaround in recent times. And then on the 4th of May, we are going to see the results of the stress testing done by the Federal Reserve on the major banks, which number something like 19. And people are going to see how the ability to cope with a severe recession is being spelled out by the people who have done the survey. And then, of course, we'll see the release of the advanced GDP data of the US. And then, of course, in Euroland, we'll see the flash PMIs, which will give one a clear idea about how the economy, which seems to be moving out of a recessionary condition, is whether it is actually doing so. On the front of monetary policy, we will see the central banks of US, Japan, and New Zealand decide about interest rates in the week. Of course, the New Zealand central bank is probably the only one which has scope to lower rates, and they might do so. But the ECB in its meeting might detail some plans about quantitative easing, which the markets will keenly await. And the Bank of England also is in a bit of a spot with its issues not having done so well. So they might end up by doing a gilt buyback, increasing the limits on the gilts that they are going to buy back. And of course, one has seen some response from the Chinese fiscal measures, which is showing some revival signs. And the countries that have actually shown stronger signs of revival are Brazil and Russia. And this is indicating that the emerging markets might pull out quicker than the more advanced countries. In India, of course, we saw the rupee following the global dictates, and it has, despite all odds, become stronger, and the NDF markets have also suffered. And we find that going ahead, if the dollar were to weaken, which we think it should, the rupee could strengthen further. We have today for you an option strategy, which my colleague will share with you, the concept and the idea thereof. And thereafter, you will take a look at the charts, which we will analyze together with you.
Hello, this is Forexserve special option strategy to hedge euro payables for a period of 3 months. Now the spot reference is 1.3167 and the expiry is 27 July 09 over 29 July 09. The forward for the period just mentioned is around negative 7 pips. So the outright rate is coming as 1.3160. Here we are buying a euro call at 1.32. So if the spot at expiry is above 32, the corporate has a right to buy euro at 1.32. And below that, the corporate buys at market. Now there's a cost involved to buy this euro call at 1.32. And the cost is around $34,000, which is about 340 pips on euro 1 million. Now to reduce this cost, we can sell a euro call at 1.40, which will create a call spread. So anything above 1.40 will get the difference between 1.40 and 1.32, which is around 800 pips. if a corporate is looking for a zero-cost structure, we can sell a euro put at 1.29, which will give us a Siegel structure. So anything between 1.29, 1.32, at expiry, corporate buys euro at market, and below 1.29, corporate must buy euro at 1.29. Now, if somebody would like to go for a more aggressive structure, we can have a look at this one, where the first two leg remains the same, but for the third leg, we'll be selling a euro put at 1.31 with a anytime knockout at 1.36. So if euro starts appreciating as per the view, and if 1.36 is seen anytime during the life of the option, we'll be left with a euro call. Both the structures just mentioned is a zero-cost structure. Thank you.
Bottom, or rather a triple bottom, we moved up higher. It has come up to the trend line kind of formation here, which indicates that this could be a flag or a wedge, which once broken here, the upside becomes quite obvious. For the moment, since we see a sell-off related to the swine fever in Mexico, which is creating some kind of tension in the American subcontinent, there is a sell-off of the major currencies and pull back into the dollar, which might see a kind of a move down towards 130.50 or so, or maybe even 130 before the up move can start again. But a breakout over 32.50 is likely to see the unit move much higher. We also now look at the Australian dollar, which also has moved up higher since last week, but again we have the similar telltale sell-off today. So once this 72.80, 73 region is taken out, the unit can move much higher. My colleague has shown you the option strategy, which is based on this view of the US dollar losing in the weeks ahead. Thank you and have a great week ahead.